Welcome back to the deep dive. When you just glance at a company's quarterly report, those big headline numbers, the revenue, the profit, well, they often kind of hide what's really going on operationally. Today, we're digging deep into the Q2 FY26 results for Tata Consumer Products Ltd, TCPL. That's for the quarter ending September 30th, 2025. And what we found is, well, it's a really fascinating look at how a major player handles all these conflicting pressures in India's FMCG market. It's pretty aggressive out there.
That's right. And just so you know where we're coming from, our sources here are pretty comprehensive. We've got the detailed financials, the press release, their investor presentation, and importantly, the commentary from the CEO and CFO on their earnings call, which was November 3rd.
Okay.
So our mission today really is to cut through all that data. We want to break down exactly where TCPL is getting that strong top-line growth, but maybe more importantly, figure out where the big margin pressures are showing up globally and why.
Right, let's hit the main numbers first just to set the scene. The consolidated picture for the quarter looked, well, undeniably strong on the surface.
Yeah, definitely. Consolidated revenue from operations hit 4,966 crores. Just for context, 1 crore is 10 million rupees, so that's almost 50 billion rupees. Huge number.
Wow.
And that was up 18% compared to last year. If you take out currency swings, it's still a very healthy 16% growth in constant currency, or CC.
Okay.
Group net profit was also up 11%, hitting 407 crores, so good growth there too.
So yeah, high growth. But here's the catch, right? The profit growth isn't quite keeping up with that sales jump.
Exactly.
EBITDA came in at 675 crores. Now that's only up 7% year on year. So the result is a consolidated margin of 13.6%. They're selling a lot more stuff, but something's kind of squeezing those profits.
Precisely. And that tension, between driving volume and protecting margin, that's really the theme running through this whole report. To get it, we've got to start with their foundation, the India business.
Okay, let's unpack that. The India core business, that's their tea and salt. It's like the bedrock for TCPL.
Yeah.
And they managed their second straight quarter of double-digit growth here. So yeah, the foundation seems rock solid.
Looking at the India packaged beverages side, basically their tea segment, Q2 revenue grew 12%. And that was driven by a pretty healthy 5% volume growth.
Right.
They're keeping things fresh, too. Like, they launched a new product, Tata Tea Agni Energy Tea. It's apparently a category first, with added caffeine rolling out in some markets.
Interesting. But the really strategic piece here, the thing that stood out to me, was how they talked about managing margins in tea. Management said, like repeatedly, that the gross margin has to stay in this tight band between 34% and 36%.
Yeah.
I mean, if they could charge more, why actively limit their own profitability?
Well, it's pure competitive strategy. Simple as that. The tea market, especially the mass market stuff, it's incredibly competitive, very commodity driven.
Yeah.
If they let those margins creep up past 36%, they're basically inviting competitors to come in, undercut them on price, and just steal volume. So management is making a very deliberate choice here. Long-term market share dominance, keeping that volume, over maximizing short-term margin. It means they're ready to actually drop prices if needed just to hold on to their share. It's a defensive strategy, really.
That's a huge trade-off. Protecting the core business, even if it means lower margins right now. Okay, now let's look at India Foods, salt and staples. Growth there was even faster, right?
Yeah, even more aggressive. Q2 revenue up 19%, and that was fueled by 11% volume growth overall. And their value-added salts, which is a segment they're really pushing, grew 23%. Very strong.
And this is where we found that surprising bit about the retail market shifting, the Nielsen gap.
Right.
The presentation showed TCPL's salt market share value as flat year on year, according to Nielsen. On paper, that looks a bit worrying.
It does. But then you listen to the CEO's commentary and you get the real context. The traditional way of measuring is just, well, it's becoming less relevant. Tell us about that number.
Yeah, it was striking.
In this quarter, 37%, nearly 40% of their total India business contribution came from channels Nielsen doesn't fully track. So think e-commerce, quick commerce, even certain modern trade stores.
37%.
Yeah. And this isn't just TCPL, it's a challenge for basically every big FMCG company still relying heavily on that traditional data. If almost 40% of your business, especially the high growth parts, isn't being measured properly,
Then the standard market share numbers are actually misleading you.
Exactly. It means the traditional analysis could be totally misrepresenting their actual position in the market.
Which means TCPL is probably doing much better in those fast-growing channels like online and quick delivery than the public data shows. It forces them, and I guess others too, to really lean on their own internal data to see what's happening. It just shows how fast consumers in India are moving beyond just the corner store.
Absolutely. The reality on the ground is just moving faster than the measurement tools can keep up.
Okay, so core business is solid, volume focus is clear. But where's the really explosive growth coming from? The future stuff. We need to talk about the growth portfolio. Management had this informal target, didn't they? Something like 30% of the portfolio growing at 30%?
They did, and guess what? They're hitting it. These growth businesses, that's all the innovation, the premium products, they now make up 32% of the India business revenue.
Wow.
And they delivered a fantastic 27% revenue growth in Q2. So, yeah, hitting that ambition.
And Tata Sampan, their packaged foods line, that's really leading the way, right? Heard some huge numbers there.
Oh, yeah, Sampan is on a tear. It kept up its strong momentum clocking, get this, 40% growth in the quarter.
40%.
It's not just growth either. They're scaling incredibly fast.
Yeah.
Their dry fruits range already hitting an annual run rate of 300 crores. The cold press oil line is at 250 crores run rate. That's seriously quick adoption by consumers.
That must take a massive push, logistically and marketing-wise.
You bet. And it shows innovation isn't just a side project, it's core. They launched 25 new products in Q2 alone.
25 in one quarter.
Yep. Including things like hyper-regional gravy mixes, like 4 different kinds tailored to specific local tastes, and new unpolished millets, tapping into that whole health trend. They're basically trying to reinvent the Indian kitchen pantry.
Okay, now we also need to touch on the recent acquisitions Capital Foods and Organic India. They're being integrated. Their combined revenue grew 16% in Q2, which sounds pretty good.
It is decent growth, yeah.
But there was some kind of hiccup in September. Something about operations.
It was, yeah, a temporary speed bump. The issue was this GST 2.0 rate change. Basically, the goods and services tax rate on certain products dropped quite a bit, from 18% down to 5%.
Ah, okay.
And that announcement, well, it triggered immediate destocking in the distribution channels.
Right. So retailers knew the price was about to fall, so they stopped buying the higher tax stock to avoid getting stuck with it. They cleared the shelves first.
Exactly that. It caused a brief sales hiccup, as management called it, mostly for Capital Foods and Organic India in September, especially in modern trade outlets where inventory moves faster. They just paused orders to wait for the lower pricing.
Makes sense. But I guess that wouldn't hit impulse buys as much, like drinks.
Correct. The ready-to-drink, or RTD, category actually did pretty well. Even with some unseasonal rains, which usually dampen drink sales, RTD saw robust volume growth of 31% and value growth of 25%.
Solid.
Tata Copper plus ZAD, their functional water, kept up its strong run with 36% growth. And they're piloting something interesting, a new energy drink called Zip Zap. It's still-based, not fizzy, and crucially, it targets that super competitive 10 price point.
10 rupees. That's going for serious volume then.
Definitely a mass market volume play.
Okay, let's shift focus now. Go global. The international business grew 9% in constant currency, which, sounds decent. But this seems to be where the big margin squeeze happened, the one dragging down the overall profit picture we talked about earlier.
Yeah, this is where things get complicated. And what's really fascinating is this kind of tale of two coffees within the international segment.
Okay.
Their U.S. coffee business actually had a strong quarter, revenue up 21%. 8 O'Clock Coffee, their main brand there, kept gaining market share in both bags and K-Cups for the 4th quarter in a row. That's just good, solid market execution.
Wait, hold on. If U.S. coffee did great, 21% growth, market share gains,
Yeah.
why did the overall international profitability, the EBITDA, fall by 17% in constant currency? That sounds like a terrible trade-off.
That's the disconnect, exactly. And the main reason, sharp swings in coffee commodity prices.
The input costs.
Yeah, Arabica and Robusta prices were stabilizing, but at really high levels near the end of the quarter. Add to that some external factors like changes in Brazil's tariff structure and TCPL, which basically acts as a price taker in the very competitive U.S. coffee market, couldn't really pass those higher costs on to consumers without risking those market share gains they'd worked so hard for.
So they absorbed the hit.
They absorbed it. Management basically said they expect margin normalization there to be at least 1, if not 1.5 quarter out. So it'll take time to recover.
So that 17% drop wasn't necessarily bad management. It was more about market exposure and a strategic choice to protect volume.
Got it.
What about their non-branded business? That saw some volatility too, right?
It did. Revenue there grew 26% in constant currency, which is strong. But the margins, they dropped sharply, down 1,100 basis points compared to last year.
Ouch.
But again, context is key here. That wasn't really a failure. It was more like a return to normal.
How so?
Margins in that business the previous year were unusually high because of some very favorable commodity cycles. This quarter, the business just went back to its typical expected low teens margin profile. So the drop looks dramatic, but it's kind of the business operating as it normally should.
Ah, okay. So it was artificially high before, now it's back to baseline. Makes sense. And briefly, Tata Starbucks.
The joint venture, yeah. Steady expansion. They added 7 net new stores in the quarter. That brings the total to 492 stores across 80 cities in India now. Revenue grew 8% year on year. Consistent growth.
And one last thing, they mentioned sustainability efforts too.
They did, just connecting it to the bigger corporate picture. TCPL highlighted they are now certified water neutral based on a third-party check, and they have a global water positive index of 2.2, which is quite good. They also boosted their score on the S&P Dow Jones Sustainability Index, up from 65 to 71.
Okay, so let's try and pull this all together. What does this deep dive really tell you, the listener?
Well, I think it clearly shows a company executing very precisely in its core home market, India. They're walking that tightrope, managing those specific 34-36% gross margins in tea to defend their share while still driving strong volume growth. And crucially, they're really delivering on that ambitious 30% growth from 30% of the portfolio target in their newer businesses.
Right.
And they did that even while navigating short-term bumps, like that GST change. Yeah, the India story looks very strong, very focused. The key challenge, though, which the numbers really bear out, is definitely the international side. It's just very exposed to things outside their direct control, like commodity prices and tariffs, especially with coffee.
Right.
For now, that spectacular growth they're seeing in India, especially in sampan and the other growth drivers, it's acting like a really powerful buffer against that global volatility.
So this report, it really gives you a perfect window into the complexities of running a big, diversified, global FMCG company. You see them managing supply chain swings, reacting to regulatory changes like GST, and constantly making these critical trade-offs. Do we protect long-term volume or go for short-term profit?
Exactly. And it really tees up an interesting question for their longer-term strategy, doesn't it? Yeah. Well, you see the incredible 40% growth in Tata Sampan. You see the strategic push to dominate these newer, often higher margin growth categories. But at the same time, they've committed to keeping that lid on margins, that 34-36% band, for their core tea business to protect market share. That's profit they're consciously not taking right now.
Yeah, that's capital they could potentially reinvest elsewhere. So the tension is...
The tension is this. Do they keep playing defense with tea margins, protecting that legacy volume at all costs? Or do they start to maybe leverage the amazing momentum in the new portfolio, sampan, dry fruits, oils, by investing more aggressively, maybe even sacrificing some tea margin, to really cement long-term leadership in those new high-growth categories much faster?
Protect the past or double down investment in the future. That's the big strategic choice they seem to be facing. A classic dilemma.
It is indeed. Definitely something for you to think about until we meet for our next deep dive.
Absolutely. We'll talk to you next time.